Hello and welcome to Smart Investing Market Insights on TaipanFinancialNews.com. I'm Krista Das. Energy has been and remains 2007's single biggest pivot point. Already we have seen oil futures edge up towards $75 a barrel. Now all it would take is a hiccup anywhere in the supply chain to push prices back to 2006's $78 a barrel. My next guest has proven that he knows how to play this sector with a perfect track record and average maximum gains of 57%. Adam Last, creator of the Wave Strength Charting System and chief editor of Wave Strength Options Weekly, is here to tell us how to profit. Adam, welcome to the program.
Good to be here, Krista.
So tell us, what strategies have you recommended to your readers in order to profit from this delicate supply chain?
Well, it should come as no shock that our single best tactic this year has been calls against the oil sector. In fact, so far in 2007, WOW readers have been positioned for about 692% cumulative gains against players like Chevron, El Paso, and the whole darn sector via the S&P's Energy Spider. What's more, the International Energy Agency is calling for supplies to come up short for the rest of the decade as demand in the 26 industrialized countries the IEA advises rises by at least 2.2% per year between now and 2012. Now, even this figure keeps getting rounded up month after month. This latest report represents a 10% upgrade from just last February. Right now, we can barely keep up with demands of 86.1 million barrels per day. By 2012, it could be up to 95.8 million barrels per day.
Why can't OPEC help?
Well, OPEC's not going to bail us out. I mean, if you combine project slippage and geopolitical problems, you can actually reduce OPEC's spare capacity by 2 million barrels per day by 2009.
How about Mexico or the North Sea or Kazakhstan, Alaska? Surely at these prices someone will gin up some additional supply, right?
No, I'm afraid not. The IEA says that non-OPEC conventional crude production appears to have reached a plateau as falling output from aging fields and setbacks from things like 2005's hurricanes in the Gulf of Mexico have slowed growth. They're not coming up to save us here.
What advice do you have for investors who want to focus on the energy sector?
Well, as an investor, you need to accept a few things. Sky-high energy prices and sky-high oil stock share prices are now a given. The great news if you're already in them, but just because prices are this high, that doesn't mean you can't find a back door into energy.
And are you referring to a specific company?
Well, I am. I'm speaking of Archer Daniels Midland. I mean, that's ADM on the NYSE. Traditionally, they're thought of as a food processor, but they've used their relationships and production and supply chain expertise to move heavily into ethanol production. In fact, they just might envision themselves as the next ExxonMobil some 10 years out.
The next Exxon, that's a pretty bold statement. There must be some obstacles in ADM's way.
Well, so far, the chief obstacle to these ambitions has been the extraordinary cost to produce corn-based fuel. I mean, I'm sure you've heard the arguments it costs more in diesel for the tractor than it produces in the end, yada, yada. To which the ethanol heads in the past have answered, well, maybe that's true and maybe it ain't, but once we scale up.
In light of this principle, what's the linchpin to ethanol's success?
Well, one of those key economy of scale items has been the amount of available corn for brewing. And word out of Washington has it right now that U.S. farmers, drunk on high demand and high prices, have planted 19% more corn this year than in 2006. Corn futures have been trading in the vicinity of their 10-year highs since the ethanol rush began in 2006. And now we start to see some adjustment.
So how is the USDA preparing for this anticipated heavy demand?
Well, now the U.S. Department of Agriculture is looking at about 90.5 million planted acres. That's
Wow.
the most corn since the 1940s. And in fact, we're seeing that ramp in corn futures reversing now.
So what does this mean for ADM?
Well, it means that their chief cost, not just for ethanol, but for many of the food products they sell, has suddenly become manageable again. And chart-wise, corn's rise showed clearly in ADM's price as shares sold off from the top line to the bottom line of an overall rising trend between May of 2006 to June of this year, pushing ADM down 17.84%. Now, we're presented with a potential turnaround in two distinct rising bottoms, creating a pennant out of which we should see a marked rally. In fact, this upside situation has already started to play out in ADM charts, as WOW forecasting has ADM moving from current levels of about $36 up to maybe as high as $46.71 in the short term alone, with gains in the long term resembling the oil companies they want to replace.
We'll be sure to keep an eye on that. Thanks, Adam.
Anytime, Krista.
If you would like to know more about corn futures and investing in alternative energies, simply click on this screen or go to taipanfinancialnews.com. Thank you for watching. Until next time, here's to great profits from smart investing.